Facebook stock hit another all-time low on Monday, then bounced back to finish the day at just over $20 a share. That's about half the stock's original price. And some Wall Street watchers are wondering if Facebook CEO Mark Zuckerberg is doing enough to help.
One man who was not surprised by any of this is Alexis Ohanian, a co-founder of Reddit.com. Listen to what he said before Facebook went public back in May.
Why would you not touch this thing with a long pole?
Well, I've got some reservations, and in part because, the Facebook business model is one that relies on display ads, sort of like Google, but doesn't have the same purchasing intent moment that Google does. When you do a Google search and you see a relevant ad, it's because you're seeking something out. With Facebook, you're looking at photos from your dad's fishing trip, and I'm not convinced that they can continue to grow this business in a way that still treats users well, and that's the concern.
Was he right? Alexis Ohanian is here now along with Rebecca Jarvis. Good morning to you both.
Morning.
Let's start with you, Alexis. What did you see that others did not?
Well, the price that they were hoping to get at that IPO just did not seem to be justified based on the business model they had. And if they're going to justify it, it's going to have to be something bigger and better than just display ads, especially now that more than half of Facebook's traffic comes from mobile, where those display ads don't really work. And then, unfortunately, while they are profitable, they're not as wildly profitable as that IPO would have led investors to believe, and it's going to take a big change.
But let's assume that the IPO was priced too high then. So is this more just IPO hangover, or is this real, true, intrinsic business problems?
I think for the time being, I would say still hangover. I'm not yet convinced because Facebook is still a huge company. It's like something we've never seen before in terms of the impact it has. If they can invent their way to a new business model, one that still respects users, like I said, because they are notoriously fickle. Look at MySpace, look at Friendster, look at all the others before it. It's going to take something big, and I think they've got the right people in the company to do it. I just don't know, because expectations obviously have been set really, really high.
Mark Zuckerberg seems to be keeping a low profile these days. Do you think that he should be doing more things publicly, Rebecca, to reassure investors?
Well, I think it depends on who you're asking about this. Within the company, what he really has to do is assure his employees that Facebook is on the right track. You don't want to lose those minds, and that's really what Facebook is about. It's about the technology. It's about the engineers that exist within Facebook that are going to come up with something, a way, ideally, to make money for the company, but also ways to make our user experience better. Those billion people who are using Facebook are very valuable, but Facebook still has to find a way to make them valuable and to make them count. And like Alexis said, selling ads isn't the only way they're probably going to do it in the future. They have to reinvent that.
But we should point out that Facebook is not the only internet company that's facing stock problems right now. You've got Zynga, there's Groupon, which has slid dramatically. I mean, the question has been, is this another .com bubble? Is it fair to call it one of those, Rebecca?
I think what you're seeing here is stocks that get priced at IPO based off of the frenzy that investors have around them, as opposed to what the fundamentals of these companies are saying about their future. These are long-term stories in most cases, and the way that investors invest in public stocks is very short-term. And when you focus on that short-term element, you can price a stock way above where it should actually be, and that's what you've seen. And most investors would say that's what you saw in Facebook. That's what you saw with Groupon.
What's the difference between now and the .com bubble, as you see it?
Well, so back then it cost a lot more money to start a company. Now you literally can just have a laptop and get going.
In your room, yeah.
And that means that you can't justify nearly taking as much of the investment as companies used to 10 or 15 years ago. Like, some of those obscene valuations were based on the obscene amounts of money they were taking to get started. And then you also have just the fact that the internet has become such a bigger part of our lives. There are startups, epic failures like Webvan from the last bubble, that are now seen born again as things like Fresh Direct. I don't know many New Yorkers who still go to the grocery store because they can do it all online and have it delivered.
These companies are also making money. I mean, at the end of the day, the difference, the big difference between the .com bubble and right now is when these companies go public, they might not be making as much money as we'd like them to make, but they have a steady stream of revenue.
Are we to read anything to the fact that Peter Thiel, the famed investor, an angel investor, sold his Facebook shares yesterday, 20 million of them?
He got in a lot a long time ago. He got in before this was a public company. So there is some of that. In the same way that employees are selling out of some of their stake, you do see investors that invested in this company getting out because they need to show a return to their other investors. I think that, you know, anybody who's looking at this stock needs to think about it individually for themselves. And they need to realize this is a highly traded stock. It is not a long-term hold right now for most investors.
All right,
All right, guys. Rebecca Jarvis, Alex Ohanian, thank you very much.
Thank you.